There are various ways that crude oil can be traded. Our focus will be on retail forex trading platforms for this instrument. Let us see how we can calculate oil in the WTI forex platform MetaTrader. The smallest price change for crude oil is 0.01 or 1 pip. So when the price rises from 40.00 till 40.01, it is 1 pip. If we trade oil on the MetaTrader platform, then 1 microlot trading size for 1 pip target is 1 cent. If we buy 1 microlot from 40.00 to 40.01, it is 1 cent or 1 pip. If we buy 1 mini lot from 40.00 to 40.01, it is 10 cents or 1 pip. If we buy 1 lot from 40.00 to 40.01, it is $1 or 1 pip. When traders calculate oil pips, then 1 lot oil trading size, 1 pip move, is equivalent to $1.
Hello traders. Today we're talking about crude oil and how to calculate pips when we trade this asset. Crude oil is the raw natural resource that is extracted from the earth and refined into products such as gasoline, jet fuel, and other petroleum products. We know that many economists agree that crude oil was and remains the single most important commodity in the world, and it's a primary resource of energy production. Crude oil is a global commodity that traders in markets around the world, both as a spot oil or derivative contracts. Crude oil is a base component of transport fuel, plastics, chemicals, and petroleum products. We know for Brent, West Texas, Intermediate, Dubai, Oman, this was just the most important benchmarks of crude oil. Oil prices affect most other commodities, as such movements in oil prices can trigger inflation or deflation. For now, in this video, we just tell a couple of words about this fuel. A type of fossil fuel, crude oil, can be refined to produce usable products such as gasoline, diesel, and various other forms of petrochemicals. It's a non-renewable resource, which means that it cannot be replaced naturally at the rate we consume, and it's therefore a limited resource. For just a basic thing to know, when you talk about crude oil composition, between 50% and 97% of oil is composed of hydrocarbons. Between 6 and 10% of oil is composed of nitrogen, oxygen, and sulfur, and less than 1% of oil is composed of metals such as copper, nickel, vanadium, and iron. Now we know the basic stuff about crude oil. Now we just talk a little bit about trading. When we talk about trading, we need to know that we can trade oil as a contract of difference, for example, if you use MetaTrader platform, but we can trade crude oil in several ways. For example, spot contracts. The price of the spot contract reflects the current market price for oil, whereas the futures price reflects the price buyers are willing to pay for oil on delivery date set at some point in the future. This is the basic definition of spot contracts for crude oil. Then you can trade as commodity. Commodity contracts, bought and sold the spot markets, take effects immediately because the money is exchanged and the purchaser accepts delivery of the goods. In the case of oil, the demand for immediate delivery versus future delivery is small because it's no small part of logistics for transporting oil to users. So we can trade spot contracts, we can trade commodity, and we can trade futures contracts. An oil futures contract is an agreement to buy or sell a certain number of barrels, set amount of oil at predetermined price on a predetermined date. When futures are purchased, a contract is signed between buyer and seller and secured with a margin payment that covers a percentage of the total value of the contract. Now, we talked about spot contracts, commodity contracts, futures contracts, we talk about crude oil, and at the end, we need to see the difference when we compare a spot versus future oil prices. Futures prices for crude oil can be higher, lower, or equal to spot price. Remember this, because the price difference between the spot market and the future market says something about the overall state of the oil market and expectations for it. If the futures price are higher than the spot price, this usually means that purchasers anticipate the market will improve, so they're willing to pay a premium for oil to be delivered the future date. So this is the basic definitions when we just want to compare a spot and future oil prices. Now, let me see the impact of crude oil on the economy and you as a trader. Higher oil prices increase prices of other fuels such as gasoline, home heating oil, natural gas, and oil is responsible for 54% of the price of gasoline. 15 distribution makes up 15% of the price of gas and taxes another 18%. The remaining 13% of oil consists of refining costs and profit. So, what we need to know, oil prices affect 95% of transportation. That creates higher food prices. It's also impact 45% for industrial products and around 20% for residential use. So all these numbers you see very complicated, but it's important to know all these numbers when we talk about crude oil because it impacts whole world economy. And we need to watch that because we as a trader, we need to know technical analysis and fundamental analysis equally. Now, we are on the main topic. So, how I can calculate the PIP for crude oil. A PIP in crude oil by most trading platforms is considered to be $0.01 or 1 cent. Remember that one lot of oil trading size crude oil for one lot price and one pip move are equivalent as $1. Using that information, one lot of oil trading size for one pip move is equivalent to $1. Traders can easily calculate oil forex trading size position in MetaTrader. This principle will help traders to learn how to trade crude oil in the forex MetaTrader platform. So let me give an example. The trader bought one lot at 40.55 and closed the trade at 40.90. In this example, the trader generated 45 pips profit. Because the trader had position size one lot, his gain was $45. So, to resume, buy one lot, gain 45 pips, profit $45 in MetaTrader. Buy 10 lots, gain 45 pips, profit $450. This is it. Of course, you can visit our website. In this article, you can see Crude Oil Profit Calculator you can use for free and make calculations. But I need to tell you two things. One thing, majority of MetaTrader platform use this equation. Sometimes you can see a little bit different. For example, 10 times higher price when we calculate lots, but it's just the small number of MetaTrader platforms. And other information is sometimes you need to calculate oil pips for better contracts for the smallest position. For example, in 10 barrel contract, the oil pip value would be 1 cent times 10 barrels, and it's a $0.1. This oil pip value is stationary as the US dollar is the quote of countercurrency in the crude oil and the US dollar pair. So let's understand how profits and losses are calculated using crude oil signals by referring to this example. Let's assume that you're buying 200 barrels of crude oil, bought at $50 each, and your profit is $55 each. The easiest way to find your profit is by using a simple arithmetic equation. This equation is profit gained at 1 barrel minus the cost of 1 barrel, then times number of barrels bought, and this equal total profit. In this case, $55 minus $50, this is the $5, times 200, this is $1,000. So you can also calculate the total profit and loss by using the pip value of $0.1. You can multiply the number of pips by 0.1 and the result is then multiplied by the lot. The result will again be $1,000. So this is the end for this part of this video when we talk about how to calculate crude oil pips. And on the end, just for conclusion, you can read this on our website. Just want to tell you this, what affects oil price. For the end, just to tell about that. Like any commodity, the oil price also fluctuates. The rate of consumption and production are two events that affect it. For example, a declaration made by the United States stating that a considerable amount of energy having drawn from their reserves proves that there has been increase in consumption of oil. Since the demand has certainly increased, the prices will likely increase as well. So, higher increased demand, price will increase as well. Remember this. This can be avoided only if subsequent supply also increases. So, oil price, the most important thing, supply and demand. Another thing, the oil prices will drop if demand declines or the supply overpowers it. For example, OPEC's news also has a huge impact on the price for oil. The price can spike rapidly if the petroleum exporting countries or OPEC organization decides to reduce production. This is because investors will buy oil in huge numbers to profit from it, leading to further decrease in its supply. War in the oil production country, delay in oil shipment for reasons like a bad weather, damage to oil pipelines, and changing US dollar and other currencies technology are a few more factors that affect the oil price. The list is not limited, but I just want to remember that this important news from OPEC and supply and demand are two most important, I repeat, two most important factors that affects oil price. So, this is it. I wish you a great day and bye-bye.